Given we're already slightly late starting, welcome to this webinar on DAC6 and MDR, what to do now. I am Harriet Brown. I am delighted to be here with Grahame Jackson of Hassans, who is a partner at Hassans. He is a solicitor in both Gibraltar and the UK, as well as being a holder of the CIOT's prestigious ADIT qualification. I am a barrister and Jersey advocate practicing out of Old Square Tax Chambers in the UK. We both specialise in taxation with an international element, which is how we come to be talking to you today about DAC6 and MDR. A couple of housekeeping points. First of all, a quick apology from me. We're slightly late because I had a complete technology collapse and then a slight emotional meltdown, but we're all here now. We're going to run through the presentation and then there will be an opportunity to ask questions afterwards, but you'll also see that our contact details are on the slides, and if you want to get in touch with us after the presentation, certainly please get in touch with me, and I'm sure the same goes for Grahame.
Absolutely.
Excellent. So there we are. Good start with the slides. So I'll hand over to Grahame now to talk you through some basic points on DAC6.
So in order to really understand what has happened in the last few days and the consequences of that, we need to do a quick overview of what DAC6 itself is as sort of almost required reading. What this seminar is not about is it's not about teaching you everything about DAC6. We are now, I think, about 17 or 18 days away from first reporting. Anybody who is impacted by DAC6 should really be in a strong position about it at the moment. But to just recap the basics. So DAC6 is an extension of the Directive on Administrative Cooperation, which is the basic framework document which allows the tax authorities around Europe to interact, exchange information and share documentation about taxpayers. And DAC6 specifically is designed to impose on people who design, market, implement or assist in the design, marketing and implementation of what are called cross-border reportable arrangements, which exhibit the predefined hallmarks of aggressive tax avoidance, which a little bit on that later, to impose on those people, and that's professionals, accountants, lawyers, company administrators, fiduciaries, anybody that can design a tax impactful arrangement, to impose upon them a reporting obligation to tell the authorities what it is that they've done, who it's affected, and the amount of value that the transaction has. Now, that in itself is a response to BEPS Action Point 12, which is an action point within the base erosion and profit shifting framework that the OECD set up, which requires member states of the OECD to impose obligations on taxpayers to report their aggressive tax planning arrangements. DAC6 is the global leader in this. It is the most stringent, furthest reaching, and undoubtedly not the last. So if an intermediary does the designing, marketing, implementing, or assisting in the design, marketing, or implementation of a cross-border reportable arrangement, then you need to identify whether it exhibits one of the predefined hallmarks. The hallmarks are divided into 5 different categories, A to E, and I could talk for several hours about each one, but I'm not going to. What I'm going to just explain the basics. So category A is marketable arrangements. That is the kind of bulk sale tax arrangement. It's divided into 3 types. The first is wherever there is a confidentiality clause, which specifically relates to how the arrangement saves tax. Secondly, if the arrangement has a tax-related fee element, so whether the intermediary receives a fee at all if tax is saved, or whether the fee is related to the amount of tax that's been saved. And then thirdly, if the arrangement involves standardized documents that require minimal effort to vary, minimal advice requirements, it's simply you fill them in, you sign it, and miraculously you have a tax loss or whatever. Those kind of bulk sales schemes that seem to be the penchant of celebrities. So category B is more around activities which generate artificial tax treatment. So that would be old-fashioned buying a loss-making company, round-tripping funds, double dipping for double deductions or double reliefs. Those would be reportable. And category C is situations where you have cross-border deductible payments between associated enterprises, and those associated enterprises, the recipient enterprise is in a specific type of jurisdiction, and those jurisdictions tend to be low tax or no tax, so zero or near zero, preferential regimes, generally those ones which are listed by the OECD in their blacklist, and entities which are resident in no jurisdiction, and entities which are resident in jurisdictions which are on a blacklist. My apologies, stalled there for a second. And category D is more specifically around anything which undermines automatic exchange of information. So arrangements which disguise the beneficial ownership, which make it impossible to find out the beneficial ownership, or which play games around CRS reporting. So that would be things like moving accounts out of the CRS zone, redefining entities in a way to massage the CRS reporting to give the desired result, or an opaque offshore structure which essentially just hides or puts a barrier between the CRS report and the beneficial ownership. And finally, category E is a transfer pricing arrangement. So that's the use of unilateral safe harbor rules and the transfer of business operations, risks and liabilities from one part of a group to another part of a group in order to shift the weight of the profit from one jurisdiction to another. So some of those, and that's a very, very high level overview, and I can see some questions coming in as we speak.
Hopefully all on transfer pricing, Grahame. I'll leave those ones to you.
Oh, okay, thank you. So that's a very, very high level overview. And I just want, this presentation is not about the nuts and bolts of DAC6, so Harriet and I can do, if there is still a request for it, we can easily do a nuts and bolts of DAC6 presentation. Some of those categories and some of those hallmarks are absolute in a sense, and in inverted commas, almost strict liability hallmarks. But some of them are subject to what's called a main benefit test. And some of them, the main benefit test is that one of the main benefits of the arrangement is a tax advantage. We'll get on more later on about what that means, but certainly a lot of the category C, the category A and the category B hallmarks are subject to the main benefit test. It's not all of them. Certainly none of the CRS related hallmarks have any main benefit test or even a sort of a sub main benefit test with the transfer pricing rules, transfer pricing arrangements test category E. The guidance seems to indicate that they would be looking for normal commercial behavior. So that's almost like a main benefit test. And then finally, the report itself that you need to make under DAC6 must include information about the taxpayers, about the arrangement, about the relevant law upon which you've relied, the value of the arrangement, any other member states that it may concern. It's a very, very wide reporting. It's much stronger and wider than the CRS reporting. There's a lot of free text boxes that you need to fill in, describe the arrangement, and do so in full. It's much beyond what has happened before, and it requires those intermediaries who are not lawyers and not accountants to have probably a stronger understanding of what it is that they're doing, and to delve into things maybe a little bit deeper than they have done before. But to add to that, They are not required to do any more due diligence than they are required to do for their regulatory regime and in order to fulfill the task that they are asked to do. So next slide, please, Harriet.
So we move on to look at the basics of the OECD mandatory disclosure rules. The first thing to note here is what I'm going to talk about is the OECD model. So a bit like the OECD model on double taxation. And obviously it isn't that model that applies in any given jurisdiction. It's that jurisdiction's adoption of the model, which is generally done by enacting national law. In the UK, we are doing it through, well, we have done it sort of, we'll come to that in a minute, through statutory instrument. We're going to have another statutory instrument that's we've got in draft at the moment to change DAC6 into OECD MDR. So what's actually enacted may differ from the model. So just as sort of a bit of a health warning, always look at the national legislation. So fortunately for me, to a certain extent, Grahame, by talking to you about the DAC6 Hallmark D, has already talked to you about the MDR, because the MDR was the OECD's sort of global response to the recommendation in BEPS Action 12 for the design of rules to require taxpayers and advisors to disclose aggressive tax planning arrangements. And what the OECD says is, they wanted to balance the need for early information on aggressive tax planning schemes with disclosure that is targeted, enforceable, and avoids an undue burden on taxpayers. Now, one of the ways that they've gone about ensuring there's an undue burden on taxpayers is simply to put the burden on professionals. So into what the regime refers to as intermediaries. The initial model MDR was published on the 8th of March 2018, but they are only applicable where countries have adopted them and enacted them into legislation. So my view would be that all of the EU member states have enacted the MDR because it's within Hallmark D of DAC6. Other countries, other jurisdictions that already have rules in force include the UK, Jersey, Gibraltar, Mexico and Argentina, I think, have regimes which are not yet in effect, but lots of other countries, including Guernsey, for example, have draft provisions. And so you should expect MDR to proliferate. What this means is that people are going to become increasingly aware of it, and it's going to become increasingly important, particularly because you have this mechanism whereby you avoid double reporting by only one partner jurisdiction reporting. So it is going to become a more complex network, very much like CRS proliferated in the early days as well. So that's sort of the background. As I've already hinted at, the structure of MDR is much simpler and more limited than DAC6. It's very similar in that it focuses on reporting by intermediaries. But what MDR does, it requires intermediaries with a sufficient nexus to the reporting jurisdiction in respect of a particular arrangement which has hallmarks of either a CRS avoidance arrangement or an opaque offshore structure, and we're going to come on to what those are in a minute, to make reports on them. Broadly speaking, the OECD describes the information that one is required to report as basic. What I would say is it's not hugely detailed, but it's much less basic than CRS. Reportable information is going to include all the steps that form part of the arrangement or structure, including the key details of the underlying investment organisations, persons involved in the arrangement or structure, and then the relevant tax details of the client and users of the arrangements and structures, details of other intermediaries, to the extent that such information is within the intermediary's knowledge, possession or control. So one thing that I would say is these matters are limited, are sort of, they're not, what has to be reported and by whom it has to be reported isn't unbound. However, it is pretty broad. There are some other limitations which we're not going to go into the details of today, but again, if you're interested in those as to whether or not you have to make a report, do get in touch with either or both of us. So really, hopefully, already I've talked a little bit about the differences between DAC6 and MDR. The key ones are the fact that we just have these two, DAC6 has 5 hallmarks, hallmark D of which contains the only 2 rules that are relevant for MDR. And that is, these are the ones set out in rules 1.1 and 1.2 of the MDR, which is the CRS avoidance arrangement and opaque offshore structures. Now, what I would say, on the slide called differences between DAC6 and MDR, what I want to talk about first is the similarities. And interestingly, in HMRC's what is now defunct guidance on DAC6, what they actually said was, in relation to hallmark D, because this was supposed to mirror and work with the OECD's MDR, that you could look at the MDR commentary and the way that things were defined in the MDR and adopt those within DAC6. So to highlight there, while DAC6 is broader, it's arguable that MDR and DAC6 hallmark D have a great degree of commonality. So let's look at some of the terms briefly. In terms of MDR, an intermediary is any person who is responsible for the design or marketing of a CRS avoidance arrangement or an opaque offshore structure, a promoter, and any other person that provides relevant services in respect of a CRS avoidance arrangement or opaque offshore structure, where that person could reasonably be expected to know that the arrangement or structure is a CAA or an OOS. So we've got this distinction between promoters and service providers. One thing that could be distinct between the 2 regimes is how we apply the standard of reasonably be expected to know. And one of the reasons this could be the case, I don't say it will be the case, we don't have enough information yet to say, is that a lot of the jurisdictions currently using DAC6 have a civil law base, and I suspect and anticipate that a lot of the jurisdictions that adopt MDR, while there will be some with a sort of civil law basis of law, many of them are going to share the English common law tradition, or certainly share elements of the English common law tradition. So we may see some difference in how these phrases, where they are used in both, become interpreted. Legal person, which is an important term in MDR, is very broadly defined, and really a legal person I think means anything but a natural person, and Grahame will correct me if he disagrees, but a legal person is very broadly defined in DAC6 too, so probably not too many differences there. A reportable taxpayer, it's any actual or potential user of a CAA, and in relation to an OOS, it's a natural person whose identity as a beneficial owner cannot be accurately determined due to that OOS. So, as I've said already, the key difference that we're looking at between DAC6 and MDR, and I've highlighted some of the similarities there, is that we've got these we've just got the limited hallmarks. They are actually referred to as hallmarks in the MDR, but in a different way. So we just have these 2 rules effectively, a rule about reporting in relation to CRS avoidance arrangements, and a rule in relation to reporting around opaque offshore structures. So in relation to the former, I should say, in relation to both of them, it has to be reasonable to conclude that that is part of the design. And again, this is something that I think might be, and I say this from my impression of civil law rather than any qualification in it, this is something that I think is going to be more familiar to somebody in the common law tradition, where it is reasonable to conclude. This tries to impose a objective standard of when something would or wouldn't be considered to have been designed for a specific purpose. So we've got set out there broadly rule 1.1 and 1.2 of the MDR. It just tells us about when you've got a CRS avoidance arrangement. A CRS avoidance arrangement is, there are arrangements that either in relation to which it is reasonable to conclude that it is designed to circumvent or is marketed as or has the effect of circumventing CRS legislation or exploiting the absence thereof. Just a quick point there. There must be a question around whether or not being within the FATCA regime is exploiting an absence of CRS reporting. I think this is something that isn't very clear at the moment, but will no doubt become clear in the future. Possibly of more interest is the definition of passive offshore vehicle, which again, I think is similar between DAC6 and MDR. So an opaque offshore structure is a passive offshore vehicle held through an opaque structure. A passive offshore vehicle is essentially a legal person or legal arrangement without substantive economic activity. For EU law and English law buffs here, it may be worth just considering how this is similar to tests that are applied in domestic tax avoidance legislation. And I'm thinking in particular within the UK regime of what used to be Section 13 TCGA, and the defence that where you have sufficient economic activity in a jurisdiction, Section 13 won't apply to you. There may be some useful guidance around that that might by analogy apply here. So that's a passive offshore vehicle. What is particularly interesting here is what constitutes an opaque structure, and that is one for which it is reasonable to conclude that it is designed to have, or is marketed as having, or has the effect of allowing a natural person to be a beneficial owner of a passive offshore vehicle while not allowing the accurate determination of such person's beneficial ownership, or creating the appearance that such person is not a beneficial owner. MDR goes on to set out some examples of that. Two that I can think of right off the top of my head. First of all, purpose trusts might well come within that definition. Certain foundations from certain jurisdictions, but also nominee shareholder arrangements where the facts of the situation are that the nominee arrangement does not allow identification of the person for whom the shares are held. And remember that many nominee shareholder arrangements may well, in fact, clearly identify for whom the shares are beneficially held. So as I've said, Hallmark D represents the MDR element in DAC6. So other key differences, there's no need to worry about a main benefit trust within MDR. And we're not focused on cross-border arrangements. We're literally just focused on things that are designed to obscure beneficial ownership from common reporting under the CRS.
So Harriet, could I just ask a question there? Jump in.
Oh,
there.
yes.
Back.
Oh, golly. Yes.
So basically the passive offshore vehicle test needs to can be broken down, can't it, into, it's not only its effect, which you're looking for whether it conceals or has the effect of concealing or is marketed or designed to conceal. But also it has to, if there's substantive economic activity, does that completely sidestep the definition and take you out of?
I think the better view is that it would, because you need both elements, a passive offshore vehicle held through an opaque structure. So if you have, and to use the terminology of CRS, though it's not used in the MDR, if you had an active offshore vehicle, and that was held through an opaque structure, theoretically, I think that wouldn't be an issue. And if you think about it, if we go back to the basic principles of CRS, if we have an active offshore vehicle, if we have an active company, CRS isn't worried about it anyway. The tests are different slightly. However, I think if you look at it purposively and you say, well, active trading companies that do have a proper economic presence aren't at a great risk of this form of tax avoidance.
Do you think that the word substantive economic activity could be analogous to the requirements in the new economic substance rules that the CDOTs, apart from Gibraltar, have rolled out?
I think it wouldn't be a bad place to start. There's nothing in there's nothing in law or in the MDR to tell us that, but I think And of course, some of the economic substance tests are a little bit form over substance. I'm not talking about Gibraltar there, but some of them can be a little bit form over substance. So I think you need to look at the individual cases. But I think you could probably make a good argument for saying, look, if we meet the economic substance test, can we say that we're not a passive offshore vehicle? But you're going to need to look at the facts in every individual case, as lawyers always say.
Yeah, we need more information.
As ever, we always need more information. So moving on, again, the reporting is fairly similar between the two regimes, except for the fact that we're reporting on a much narrower category of things within MDR. The CRS avoidance arrangement or opaque offshore structure, where you've identified one, will need to be disclosed to tax authorities in the relevant jurisdictions where the intermediary makes the arrangement or structure available in implementation or provides relevant services. So this goes back to a little bit to the reporting being linked to the place of the service provider, the intermediary. So it could be a promoter or a service provider. And so those are the requirements that are there set out under reporting. The reportable information, this is the basic information that we were talking about. The first bit of it, I agree, is quite basic. So the name, address, jurisdiction, and TIN of tax residence of the person making the disclosure, any client of that person in respect of the arrangement or structure, any user of the CRS avoidance arrangement or beneficial owner of the OOS, and any other person that's an intermediary. So you're not giving a lot of information there. Where this reporting becomes more difficult is deciding to what extent you're going to include details or to what level of detail you give of the CAA or the OOS. A good starting place there might be guidance that your jurisdiction has issued on that point. But again, really, that's going to be just a matter of thinking about it. And again, Grahame, that's not very different to the situation with regards to DAC6, I don't think.
No.
So the good news is we've got a lot of commonality, and if you're in MDR rather than DAC6, as the UK now is, it's probably good news for you.
No, it's worth noting that the reporting requirement in the UK and in, well, we'll talk about what Gibraltar's position is in a minute. In the meantime, you're reporting under CRS requirements. Your report should fulfill the CRS requirements, not the MDR requirements, until MDR itself is in place in the UK. Yes,
that must be right. Yeah, but we'll talk, as you say, we'll talk about that more when we move on, which we will do now. So now I want to talk to you about a moment that was personally very painful for me, and I think not much less personally painful for Grahame, if not more so.
I've made very odd life choices in the last few months.
We should perhaps say that Grahame and I were until New Year's Eve 2020 most of the way through a book on DAC6, which has since
specifically UK's implementation.
It requires a bit of updating, let's put it that way. So
73,000 words we've written.
So what happened was this, as most people, if not everybody, will be aware, on Christmas Eve, the UK finally managed to get an agreement for the terms on which it would leave the EU on the 31st of December. And buried in there, in the sort of information on that, was a little clause which said, a party shall not weaken or reduce the level of protection provided for in its legislation at the end of the transition period below the level provided for by the standards and rules which have been agreed in the OECD at the end of the transition period in relation to A, the exchange of information concerning potential cross-border tax planning arrangements. And that reference there to OECD rules on exchange of information is a reference to MDR. Now, it should be noted that the UK Revenue, HMRC, only actually released its own guidance on the DAC6 legislation in the UK, and it's extensive guidance. It was a big job, evidently. That guidance was only released on the 29th of October. For that reason, and a number of other reasons, including a report that the UK had to write because it adopted DAC6 in the transition period on how DAC6 would continue to apply, both if the UK had a deal and if it didn't have a deal, it looked very much like the UK would just stay in DAC6. And given the UK's current approach to tax avoidance, that didn't seem totally unlikely either, because of course, while it involves giving information, it also involves receiving information. So I considered it fairly likely that the UK, in fact, I considered it almost certain that the UK would remain in DAC6. All I can say is don't take tips on horse races from me, because quite late on New Year's Eve, it was announced that the UK wouldn't be involved in DAC6, and they would be adopting rules equivalent to the OECD MDR within the next year. And so essentially the announcement was twofold, and you've got that on the slide there. Reporting under DAC6 is required for a limited time, but only for your Hallmark D arrangements. So that's your opaque offshore structures and CRS avoidance arrangements. And the UK is going to give us some new rules to remove all the DAC6 stuff and just put the MDR stuff in. We do have some draft legislation, I think. I haven't looked at it in any detail yet. So that's where we are. Effectively, the UK, having adopted the legislation, written its guidance, pulled out of DAC6 at the last minute and is going to go with OECD terms, which it is perfectly entitled to do under the agreement. So while whoever negotiated the FTA may or may not have been thinking about this, but somebody was thinking about this. Anecdotally, from things that we've heard, I consider it fairly probable that the decision to drop down to MDR was actually made between Christmas Eve and New Year's Eve, and not before that point. Of course, we'll never know, but we are where we are. So that was the events of New Year's Eve, and the outcome of that is that the UK is no longer in DAC6. Well, it's sort of half in, and it's got 1 foot in and 1 foot out of DAC6, but you're only reporting on Hallmark D at the moment. And I think Grahame, oh no, I'm going to tell you about UK reporting first, and then Grahame's going to tell us about the interesting and difficult position that Gibraltar finds itself in. So UK reporting has changed since the 31st of December. And what I want to say really is, as my headline point, if you were preparing to report under DAC6, sorry, that should say 31st of January 2021, on your historic matters, then you are well prepared. If you were looking at making a report because you came within Hallmark D, pretty much you just need to still go ahead and make it. If you haven't already made a report and it was going to be on Hallmark A, B, C or E, don't make a report at the moment. Make the Hallmark D report, but as Grahame noted earlier, make it, give the information that's set out in the UK legislation based on DAC6. Do not go back to the OECD MDR. We're not there yet. We've still got the DAC6 reporting regime. So to the extent it differs, make sure you're reporting the right things. But you do not need to report on any Hallmark, on any arrangements within any Hallmark other than Hallmark D. The reporting time limits haven't changed. So for arrangements implemented after 1st of July 2020, it's 31st of January 21. For those implemented between the 25th of June 2018 and the 1st July 2020, it's the 28th of February 2021. And for anything new, so anything after the end of last year, you've just got to report within 30 days. So that hasn't changed. My final point here, what if, say, you have been organised, your client has been organised, you decided you need to make a report because you'd got a Hallmark A arrangement, and you put your report in on Christmas Eve because you wanted to have it all done and dusted before Christmas. Don't worry, is the thing I'd say first of all. At the time that you put your report in, you knew it was going to be required by probably the 31st of January. And so I don't think you could be criticised for having put a report in a month before the deadline. That doesn't seem excessive to me. And the fact that those rules have then changed so that you didn't have to put a report shouldn't make any difference. So while your client might say, well, we now don't have to report and you've reported, I don't think there's a lot they can do about it. Unfortunately, I don't think there's a lot you can do about it either. And it will be interesting to find out, if we ever do, whether or not HMRC actually exchanges that information or hangs on to it and just exchanges Hallmark D. And I suspect it will be the latter, but you just never know. So now Grahame is going to talk to us for a little bit about reporting in Gibraltar.
So, right, yes. So Gibraltar implemented DAC6 on time, or slightly 30 days late, much earlier than many other countries in the EU. And we were full steam ahead for implementation by either the 30th or the 31st of January, depending on how you read the extension. So this has come as a bit of came as a bit of a surprise, I think, to the profession at least, if not to the authorities. We don't know whether they knew in advance. But the Income Tax Commissioner, who is the relevant authority here in Gibraltar, has obviously paused for thought as a result of this. Now, there are several different pressures on him and on Gibraltar as to whether they implement. So aside from the usual, oh, you've stepped away from a reporting regime, sort of general perception type point, there is the question of the, I think it was signed almost 2 years ago now, or certainly, yeah, almost 2 years ago, the Spanish agreement, the agreement between UK and Spain relating to Gibraltar, which plays the role of a double taxation treaty, though it is certainly unique in its provisions, but it contains in it an article which says that Gibraltar will maintain any EU legislation in force on the day that they leave. Now, that we leave the EU. Now, the question is that treaty in force yet? And it isn't, because the Spanish and the UK parliaments haven't ratified it yet, and it can't be in force until the 1st of January next year from the Spanish perspective at the earliest date. So we have like an unenforceable document that says that we will continue all EU legislation in force on the date that we leave. But so we don't have any extant obligation, it seems to me, in law today. As far as we are aware, and the Commissioner has made this clear to the various organisations in GIB, he is seeking to take us to a position similar to the UK if he has the power to do it, and he believes he may do, but he's taking advice as we speak. I was hoping, well, first of all, they indicated that there would be an announcement last week. That's been delayed. It's supposed to be this week. I was hoping it would be before we came on air. I had a text just as we started from a friend I've got in the Gibraltar Society of Accountants. Says he's not heard anything yet. So if anybody of the 75 participants has heard that since we've gone live, the Commissioner has made an announcement, please raise your hand. So that then leaves us with some questions. As at today's date, the regulations are in. The Gibraltar intermediaries, if they have an EU nexus, have an obligation to report. But obviously, Gibraltar is no longer in the EU, and the regulation, the rules in the Income Tax Act specify where an intermediary has an EU nexus. Now, we used to read Gibraltar in the word EU, and we used to read Gibraltar in the word member state, but there's been no amendments to this section of the Income Tax Act to take into account the fact that we're not in the EU anymore. So does that then mean that unless it's amended, the Gibraltar legislation is written in such a way that a Gibraltar intermediary who doesn't have a nexus anywhere else has no reporting obligation? That's not entirely clear. And if we did decide to either just do category D or do the whole thing, or we were unable to not do the whole thing, then that legislation needs to be amended. It hasn't been amended yet. We've got, 17 days to the first batch of reporting That's under Gibraltar law, it's 18 days in UK. 17 days to the first batch of reporting in Gibraltar. It is entirely unclear what the legislation is going to be amended to say. They could just put in the words and Gibraltar, or and Gibraltar and the UK. They could take out all of the, or just maybe put in a clause that says until further notice, A, B, C, and E don't apply. We haven't seen any draft legislation, and we're unaware of what's going on. The advice that I'm giving to my clients and anybody who's in the room who's a Gibraltar intermediary is to continue to work towards category D. That is the best case scenario. You should already have a large amount of the work done over everything else, because we are so close, and we have been talking about this for a couple of years now. But you should not just put your pens down, because category D will definitely happen if the Commission's indication is correct. So continue to work, continue to review, looking through your files, doing the analysis, and using the tools that you've got. So I think that continuing to move, and fingers crossed for a timely announcement, but unfortunately there aren't any answers. I think I might have answered the question that we got from Chris Kitely-Pugh earlier on by email about whether it applies to a Gibraltar intermediary now. I agree with you, Chris. I don't think it does as it is written. But I doubt that as it is written, will be the case on the 30th of January. So, Harriet, next slide, please. So, this is me again. Right, so for those who are not in the UK or not in Gibraltar, the question arises, are UK and Gibraltar still in scope when I'm reviewing my arrangements? And I think this generally goes to a wider question about, are non-EU facing arrangements that save tax in other jurisdictions within scope? And I think we need to think about how the hallmarks are divided before we can answer that question. And the hallmarks are divided into two types. There are those that have as part of them the main benefit test, which is what we talked about earlier on. And the main benefit test is that the, or one of the main benefits of the arrangement is a tax advantage, and a tax advantage we'll talk about in a moment. And those main benefit test hallmarks are category A, category B, and category C, some of category C anyway. Firstly, where there's confidentiality, contingent fee, standardized tax product. Category B, loss buying, converting income into capital or circular transactions. And category C, cross-border deductible payments to associated enterprises in low or no tax or preferential or exempt regimes. Low or no tax is the zero rate jurisdictions like the classical BVIs or the Caymans. Preferential, it depends on which jurisdiction you're in. They discuss whether some of the guidance indicates that it's an OECD blacklisted regime. Some of the guidance talks about anything which is a preference over other parts of the economy, like special economic zones or things like that. And full exemptions tend to be things like specific income streams are exempt from tax in deviation from the normal operation of the tax system that you're talking about.
Grahame, is it worth mentioning there that there is a question mark, maybe a slightly bigger question mark than we initially thought, over territorial tax regimes and how they fit into all of this?
My feeling is there isn't a question mark about it. The people who say they're an exemption are wrong.
Well, as you know, I agree with you, but there are people who say they're in an exemption. So it's a point worth making, and there isn't.
It is a point worth making. Some people, and I did couch my description of this in a way that took that point into account. Thank you very much for pointing that out, Harriet. Some people believe that a territorial regime amounts to an exemption of tax of income which is outside the territory. I am firmly of the opinion, and I think Gibraltar as a whole, which has a territorial regime, is of the opinion that that's not an exemption. That's just the way the system works. And we could, again, talk for quite some time about that. It's certainly worth thinking about. The main indicator that I think that it's wrong to view anything which is different from your system as being an exemption is that this category C aims itself at the treatment in the jurisdiction of residence of the recipient. So you need to understand it in the terms of that tax regime, not just say, oh, I'm in Belgium or wherever, we tax money that you find on the ground, therefore money that you find on the ground in Italy, if you don't tax it, is exempt from taxation. I think that's certainly a sensible and reasonable approach, but there is some discussion about it, generated by us mostly. So that's the main benefit test hallmarks, and then you have the non-main benefit test hallmarks, and they're almost like the concept of strict liability. You don't have to have any effect, you don't have to have any benefit from the arrangement. The arrangement just has to be like this. So with category C, if you make a cross-border deductible payment to an associated enterprise resident in no jurisdiction or resident in a blacklisted country, that's joint member state blacklists, not just individual member states blacklists, or the OECD blacklist, FATF blacklist, or there is a double deduction or a dual relief, then it is always triggered. You don't need to look for a tax benefit. Secondly, with category D, CRS avoidance and disguising beneficial owners, as Harriet has talked at length about, that is also similarly strict liability. There's a report automatically if the arrangement exhibits that characteristic. You're not looking for any effect. And category E, transfer pricing, unilateral safe harbors, transfer of hard to value intangibles, and business restructuring transactions. Again, automatically reportable. You don't need to look for any benefit. Shall we move on to the next slide, Harriet? So once we understand that there are two types, there are those that have the main benefit and those that don't have the main benefit test, then because the main benefit test is couched in terms of a tax advantage, we need to think about what a tax advantage is. Well, a lot of jurisdictions have imposed their own domestic definition, or they've referred to a pre-existing definition. But the standard EU definition of a tax advantage is contained in that Commission recommendation on the 6th of December 2012, and it lists five examples or 5 things that are required to have a tax advantage. And that is that either an amount is not included in the tax base, the taxpayer benefits from a deduction, a loss for tax purposes is incurred, no withholding tax is due, or foreign tax is offset. So this definition is the foundation upon which the main benefit test is built. And that is confirmed in various pieces of guidance, including the brand new hot off the presses Maltese guidance that came out about 5 or 6 days ago. Sometimes, like I said, there is a local definition, but they're mostly variations on that. So the main benefit test itself, to use the exact language, is that the test will be satisfied if it can be established that the main benefit or one of the main benefits, which having regard to all relevant facts and circumstances, a person may reasonably expect to derive from an arrangement is the obtaining of a tax advantage. Now that is not about intention, it is simply about effect. In fact, the Italians, great system, they give you a 50% rule. If the main benefit amounts to 50% of the value of the benefits which you can value, then the main benefit test is triggered. That's an entirely new, unique system within the EU, but it's interesting to know that they've taken that approach. The UK and several others, including possibly France, I'm not quite sure about France, I've put it in there, but I'm not quite sure. Luxembourg, Malta, the aborted UK legislation, they have a legislative intent element as well. So if you have the 5 or whatever the 5 or 6 defined characteristics of a tax advantage, and the arrangement deviates from the intention of the legislature. Luxembourg and Malta add that through their guidance. UK added it in their legislation. The Austrians have a sort of a requirement for there to be an element of tax avoidance. That's if you think of the DAC6 decision tree as a decision tree, then it's further up, but it has the same effect of forcing some sort of deviation and conscious avoidance onto the doer of the arrangement. So, if the tax advantage does not concern an EU tax, then the main benefit test cannot be met. Why is that? Harriet, can you just flip me on to the next slide for a second? Okay, now go back. I thought there was another slide. Okay, so why have I said that? Well, the DAC itself has a scope clause in Article 2. That's the whole of DAC, not just DAC6, but the whole of DAC. And in that clause, it says that the scope of the directive applies to taxes of member states. So wherever you see the word tax, you assume that that only means EU member states, unless the context otherwise provides. So, can an arrangement which saves UK tax meet the reportability under a main benefit test hallmark of DAC6? I don't think it can. And I don't think that you would need to report an arrangement put in place with a Luxembourg company that simply saves UK tax. There can be other reasons why you would need to do that, not necessarily singling out Luxembourg. It could be any company within the EU. I think that has to be the conclusion. What do you think, Harriet?
I agree with you, not only because of, what the DAC says, but also because of, and I know we've disagreed on this, Grahame, but territoriality, and I use the analogy with the UK transfer of assets abroad regime, where you have a motive defence, and you have to have a motive of avoiding a tax, and it's not restricted to UK income tax, even though it's an income tax provision. And so there's quite a lot of quite ancient case law on whether or not that, on what's included within the meaning of tax. But one thing that it's absolutely certain isn't within the meaning of tax is a foreign tax. So, for example, I had a case where HMRC argued that the motive defence wasn't available because the taxpayer had been avoiding tax in Malaysia, of all places. And this was just a non-starter. And the second it got in front of lawyers, we got a settlement and we never made it into the tribunal. And while it's slightly different because this is the EU, I think the same thing broadly applies here. And you know, if you're not convinced of my argument on the basis of territoriality and jurisdiction, what earthly point would there be in the EU knowing about people avoiding Panamanian tax? Why would they want to know that? I can't think that they would. I don't see the relevance of it. So not only for the reasons you state, but for a variety of others, I think that must be the correct interpretation.
Yeah. So just to be clear, though, that's, if we could go back one slide. This conclusion, too far, one step back. There. This conclusion only applies to those hallmarks which are subject to the main benefit test. The others are not. They would, look at that, she's got a laser pointer. The others would still be reportable because they are just strictly reportable. You're not doing any measure of effect when you're reporting those. You're just analysing the characteristics. So if we could go forward again, Harriet, thank you. So that then leads us to one final slide, which Harriet's going to talk about, which is, well, does the tax advantage itself, not only is the tax in question, but can the tax advantage arise outside the EU? Over to Harry.
So this really arises, this concern arises in relation to the Luxembourg guidance, and I should state we've put a translation of that guidance there. This is a very unofficial translation. It's actually from Google Translate, so we can't be completely sure what it really says, but this is the best that we can do. And what we think it says is that the main benefit test must be met in relation to the types of taxes and levies referred to in Article 2 of the directive. But it goes on to say, the tax advantage does not necessarily have to be obtained in a member state, but can also be present in a third country. So what on earth does that mean? If it's got to be within Article 2 of the directive, then one would say it must be an EU tax. But that doesn't appear to be the case, according to Luxembourg. And we understand anecdotally the Luxembourg authorities have been asked about this. And they haven't been able to come up, or they haven't yet given a clear answer. There's a possibility that where a tax advantage in a non-member state has a knock-on tax advantage, or possibly even other advantage in a member state, this would be sufficient to trigger DAC6 within the Luxembourg guidance. I'm very dubious about this. But we just sort of mention that for completeness. My view is that it's fairly clear that the main benefit test needs to be triggered by an EU tax advantage, and I would argue quite strongly for that position.
So I think that this, and as with so many pieces of guidance that we read, the authorities sort of have a sense that somebody will do something clever. They can't quite work out what it would be. So they put a sentence in that sort of covers it off, and then leave us to worry about it. Do you think that might be the case here, Harriet?
I mean, I think quite possibly they've gone, well, we don't want to definitively state that it can't be a third country tax advantage, which is why they say does not necessarily, which is not particularly strong, is it? So yes, that could be it. We don't know how people are going to get around this, but we want to make it clear that you can't. So we won't make any sort of categorical statement that might actually be helpful in guidance.
There are a lot of very clever lawyers and accountants in Luxembourg.
Well, maybe they've brought it on themselves then by being too clever.
We'll edit that out. Okay, so the question comes up, well, what can Harriet and I do to help you now? Well, for DAC6, those of you inside the EU zone will have to continue to prepare for reporting. We have, to be honest, experience and knowledge over, as hopefully you've seen, a wide range of jurisdictions. We've read a lot of guidance. We understand the directive in a way that probably not so many people do. And we can provide consistent training for your teams across the EU. There are a lot of fiduciaries and intermediaries that have offices all over. I know I've got one locally who's got offices in Cyprus, Malta, Portugal. So we can provide that kind of consistent training, an overview of the framework of DAC6, and help your people understand and how to implement the mechanisms. We have an analysis tool which we can supply to you. It's very basic in that it's very easy to use, but it's complete and gives you a result that we can help you, that will help you to guide your analysis of the arrangement. So when you review an arrangement, you have the tool next to you. It's a series of yes, no, maybe questions, and it gives you a result to help you to rationalize your thoughts. And it's very good because it forces you to think in the straight line that's required. DAC6 is ultimately nothing if it is not a giant flowchart. I'm sure both Harriet and I know I have, sat at our dining room table about 2 years ago and drew it all out. So that kind of tool that makes you go through the process is very useful. Those of us outside the EU now, that still sounds odd. Those of us outside the EU, but who deal with the EU, then you need to understand DAC6 as well. you need to grasp it in detail, because if you have dealings inside the EU and you are outside the EU, then you will undoubtedly recently have been receiving emails from law firms inside the EU saying, we think this might be reportable, or then the best one, there may be reporting on this arrangement.
The other thing that's important if you're outside of the EU is understanding the interaction between DAC6 and MDR, to the extent that there is an interaction, particularly with regards to double reporting.
Yeah. Okay, so we can provide you assistance with all of those things. On MDR, MDR is coming. Again, we can provide training, analysis, and consultations. These are the 4 things that we can do to help, or 3 things that we can do to help you. So you have our contact details. Please reach out to us if you have any requirements. There's our contact details. And now I think we're going to go to the Q&A. If you're ready, Harriet.
I am. Let me pull up the questions.
So I think that I answered Chris Kitely-Pugh's question.
I can't see that one.
Which was sent to us by email before.
Oh, yes, of course, yes. Which
was around, does the Gibraltar intermediary still now, because our legislation is written in terms of EU and member state, do we actually have a reporting obligation? As it is written today, I don't think we do. As it will be written tomorrow, probably.
Okay, so shall we have a look at the questions on the first question is an easy one. Will the slides be shared with the participants? Yes, I believe they will be. So yes, you should have those. The next question, the EU recently agreed new rules for DAC7 that will see member states automatically exchange information on income earned by sellers on digital platforms from 2023, whether the platform is located in the EU or not. Yes, this is a really interesting approach, isn't it? On the basis that the UK have left the EU and will currently limit DAC6 reporting to Hallmark D in line with the mandatory reporting approach, would you anticipate the UK will not report under DAC7 and instead maintain alignment with OECD standards on digital and crypto? Look, this is a bit of a crystal ball gazing question, and I have to say that having shattered my crystal ball on New Year's Eve, I haven't got it so desperately wrong. I'm not sure. I would have thought that it is more likely that it will probably align with OECD standards rather than EU standards, but anything could happen. If I had to have a punt, I might put a tenner on OECD standards. I wouldn't put a lot more on anything after what happened on New Year's Eve, but I don't imagine we'll be going back in with the EU, not least just because the mechanism to sort of bring that across is going to be clunky, and there may be political ramifications of doing that. Grahame, I don't know if you agree.
I think it will be something that will be negotiated. And if it's a useful tool in the negotiations, then we'll do it. And if it isn't, we won't. I think right now, to be honest, everything between the EU and the UK is about negotiations. So I think if anybody's read the free trade agreement, it's mostly, yes, we agree not to be nasty to each other. Let's have a committee. So that's where we're going to go. It will probably go to a committee and they'll thrash it out. But
okay, Nicholas, I hope that answers your question.
Yeah. So, Pedro, we have seen a much wider approach to the meaning of legal professional privilege in some jurisdictions, such as Malta, where a corporate services company claims that they are covered. Do you think they are behind the curve, or have other jurisdictions unnecessarily narrowed the application of LPP? Well, I take a traditional approach to LPP, to legal professional privilege, which is it has to be lawyers. I know some jurisdictions give it to accountants. I don't understand the thinking about how a corporate services company has legal professional privilege. However, the directive says that legal professional privilege is defined in terms of the member states. So if Maltese law says that the company services company has legal professional privilege, then it does. I don't understand why that would be anything other than it's convenient to do for the legislature. But if that's what the law says, then that's what the law says. I haven't read that piece of the Maltese guidance yet.
So yes, I mean, I think Graham's absolutely right that legal professional privilege is going to depend on the domestic position. This was a live issue for a number of reasons in the UK. Who has legal professional privilege, or communications with whom give rise to legal professional privilege is probably a better way to put it. This was a live issue maybe 5 or 10 years ago, until we got the prudential decision from, I believe it was the Supreme Court. Yes, it was the Supreme Court, which said, no, it's just lawyers, no accountants, tough luck. So what I would say is, yes, it's going to depend on the law in the individual jurisdiction, but if the law in your jurisdiction isn't clear, you may be wise to take a narrower approach, because I think the Supreme Court was quite dismissive of the idea of the widening of legal professional privilege to others other than lawyers. And of course, because it involves a narrowing of what information one can obtain, it is something that the court is likely to interpret, in my view, is likely to interpret narrowly rather than broadly. So if you don't have clear legislation or case law on it, you might just want to think about whether or not it's better to err on the side of caution. Which I hope answers your question, Pedro. We now have a question. Would a Jersey resident company that meets the Jersey economic substance requirement automatically be considered to carry on a substantive economic activity? We sort of talked around this a bit earlier. And I think what I would say about that is, you're going to need to look at your individual facts. You want to look at your individual facts because the two things aren't aligned, particularly because the two things aren't directly aligned, and substance tests vary from jurisdiction to jurisdiction. So even within Jersey, I do know the Jersey substance test reasonably well. My view would be, if you meet the economic substance test, that's a good starting point, but you would still want to carry out some form of analysis to satisfy yourself. Though indeed you may want to look at that from the perspective of trying to see, sort of doing a global analysis that covers your economic substance requirement and whether or not you're going to come within this hallmark D MDR position. So I think that's a really good question, Matthew. Thank you, and I think it's a good starting point. I don't think it's a complete answer, so I would proceed with caution. Unfortunately, I don't think you can just tick all the boxes. Graham.
Yeah, so I think this question from Matthew is a very sensible question, but I think it betrays the approach that a lot of people take, that they look for a general principle which carves out large bits of work for them. So I've been asked variously, are loans reportable? And is this reportable? Is that reportable? I think the point is that you need to consider everything on a case-by-case analysis. And unfortunately, you can't avoid the legwork of looking at every single arrangement and thinking, does this meet the test? Does this not meet the test? I'm afraid that's just the way it is.
But as I say, you could do a combined sort of global analysis that incorporated both your economic substance test and whether or not you are a passive vehicle, or all in one, because that would make it one work event rather than two. So yes, unless you have guidance to the contrary, Matthew, and I haven't seen that, but I haven't looked too closely, so you may have. And if you do, please drop us another question and let us know. I would say proceed with caution, but it's a good starting point. So,
Casey, does that mean if you do not have any reportable events, there is no requirement to make a report? Correct. If you have nothing to report, you don't need to report. There's no need for a nil return. So, because this is something, whilst that seems a very simple answer, there's actually, it goes to something else. You're reporting arrangements, not entities. So what you're looking for is actions. A lot of people ask me, I don't know if Harriet, if you've had this, they'll say, okay, so do I need to report it? Because with DAC6, there's a there's a backstop date of the 25th of June 2018. And people say to me, do I need to report any company which is incorporated before that date? And the answer is, it depends. What's it done? The fact the company existed before that date is not the point. What has the company done? Report the things the company does, not the company's existence, unless the company's existence is part of the doing, as part of the arrangement. But it's important to think in terms, and in fact, only yesterday I was giving this piece of advice. You need to think in terms of actions, not in terms of structures. That's the way to approach this. Would you agree?
Sorry, yes, broadly I would. I think possibly the opaque offshore structures part of Hallmark D and of the MDR is possibly does cause people to be slightly misled into thinking you are reporting structures rather than actions. But yes, I agree with you broadly. You're reporting the establishment of something like that, or the yes, yeah. So I think that's probably broad. Yes, I do agree. I should have said yes, I agree, shouldn't I?
It's fine. You're a barrister. It's okay. You're going to use 20 words where one will do. Right. So, Michelle, is the template from tax administration standard across EU countries? Well, I think each jurisdiction has issued its own schema. I've only really looked at the Gibraltar one. I haven't looked at the UK one. Oh, well, there isn't a UK one anymore. But not all the requirements are identical across the jurisdictions. So this is for DAC6, not for MDR. Poland has a very different, has a much wider regime. Portugal looks for domestic arrangements as well as cross-border arrangements. So those differences will mean there must be differences in the schemas, but I think they generally follow the same structure, even if they're not exactly identical.
So I think that just leaves us with Sarah's question. Does the opaque offshore structure include a nominee shareholding arrangement? And again, we touched on this briefly, but Grahame, I can see on the Q&A it says you're typing an answer, so you've obviously got some.
That's just because I've got the box open. I'm not actually typing. I did half type an answer and then decided to leave it.
So look, one of the things that's relevant here, the MDR, when it's talking about opaque offshore structures, it uses the legislative or the drafting form of giving a general sort of description of what's included and then some specific examples of what will be included. So it sort of says an opaque offshore structure is X, comma, including, and then it gives a list. And certainly some types of nominee arrangement I think there is nominee arrangements is mentioned there. Though, of course, because it's not an exclusive list, they could come up otherwise. But I stick by what I said. While a nominee shareholding arrangement can obscure ownership, it can not all do. I have drafted nominee agreements which quite clearly state for whom the property is held. It's very easy to identify the person. Now, is it easy to identify the person from a register? No, it isn't. So then I think you're looking at whether it's reasonable to conclude that it meets those requirements. So again, unfortunately, what I would say is you do need to look at it on a case-by-case basis, because while there isn't a subjective element to the test, there is this objective element that you look at what sort of the reasonable man would think it was trying to do. And in some nominee shareholding arrangements, they might say, yes, that's right. In others, they might not. Grahame, what do you think?
So I think, and this is understanding me as more the DAC6 guy than the MDR person. For category D, I would say that the guidance, I've definitely read guidance that says this, and I'm sure I included it in this in something I've written at some point, that if CRS is functioning properly, or there is an ultimate beneficial owner register which identifies the UBO, then the nominee shareholding arrangement does not meet this criteria. So we have a UBO register. We can't do those nominee shareholding arrangements that don't disclose the principal, because we have a legal obligation to disclose the principal. So in Gibraltar's case, and if you've got a UBO register, I would say absolutely not, because this is something that terrifies company managers, absolutely terrifies them from a workload perspective, where they've as a standard procedure set up companies with a nominee shareholder for no reason really half the time, other than, and I know I used to be a company manager, other than that's just the way we do it. And then somebody says, oh, if you're not disclosing the beneficial owner, you need to report everything. And the immediate thought is, oh my God, I've got 4,000 companies, I need to report every single one. If there's a UBO register, if there are mechanisms for the authorities to identify the ultimate beneficial owner, the guidance that I've seen around DAC6 indicates that does not trigger category D.
Graham, it's worth noting, I've just had a quick dig into MDR, and rule 1.2 D little Roman 1, and this is what I was talking about, where it says an opaque structure is a structure for which it is reasonable to conclude that it is designed, etc., of allowing a natural person to be a beneficial owner of a passive offshore vehicle while not allowing the accurate determination of such person's beneficial ownership, or creating the appearance that such person is not a beneficial owner, including through the use of nominee shareholders with undisclosed nominators. And so I think what I would say is, the way I interpret that is, if you do have disclosed nominators, then it's not a problem. It's only where you've got that additional element, and I think that's axiomatic in any event. But yeah, I think the MDR, its wording is reasonably helpful there from the MDR perspective.
Just to give some more examples of things that I would trigger that, I think that would trigger that. I think that I'm going to give Harriet £500 to establish a trust for my children, and she'll be listed as the settlor. That would trigger it, because I've actually provided the money. Also, a structure, let's imagine a structure where you've got a company that's owned by Grahame, but Harriet's got an option to take all the shares for nothing, and any dividends Grahame receives, he promises to give to Harriet in return for £1 at some point later. You know, we could build documents that give Harriet the effective beneficial ownership without actually crossing the line. I think that would be very close to the wire.
Yeah, and certainly those your trust example is a really good one, because that sort of approach was of naming somebody else as the settlor was quite common, I think, in the 90s in certain jurisdictions, and certainly more than one jurisdiction. So I'm not singling anybody out. And yeah, I mean, I think ultimately it doesn't essentially result in straight up, at least sham, if not fraud. But anyway, yes, I think that would definitely be caught, if not by national legislation or law that might say that's a bit dodgy. Yeah.
Okay, so we're out of questions.
I think that's everything. So unless there is anything else, thank you very much for listening. As we said at the outset, if you do want to get in touch, if you come up with a question in the middle of tonight that you didn't get a chance to ask today, do just drop us a line. We'd be delighted to hear from you. Best of luck with your DAC6 and MDR obligations, and thank you for listening.
Thank you very much.